The SALT deduction cap just went from $10,000 to over $40,000. If you freelance in a state like New York, California, or New Jersey, you have probably been waiting years for this. But here is the question nobody is answering clearly. Does this actually help freelancers? Or is this another tax break that sounds great in a headline but barely moves the needle for self-employed workers? Let us break down exactly what changed, who benefits, who does not, and the strategy most freelancers are completely overlooking that could save you far more than the SALT cap ever will. Welcome to the Freelancers Wealth Blueprint. We help freelancers and self-employed professionals master taxes, build wealth, and keep more of what they earn. If that sounds like what you need, subscribe and hit the bell so you never miss a video. First, let us make sure everyone understands what SALT actually is. SALT stands for State and Local Taxes. When you file your federal tax return, you can deduct certain state and local taxes you paid during the year. This includes state income taxes or state sales taxes, but not both, plus property taxes on real estate and personal property. To claim this deduction, you must itemize your deductions on Schedule A rather than taking the standard deduction. Back in 2017, the Tax Cuts and Jobs Act capped this deduction at $10,000. For freelancers in high-tax states, that cap was painful. If you lived in New York City and paid $25,000 in combined state income tax and property tax, you could only deduct $10,000. $15,000 in legitimate tax payments became invisible to the federal government. Now, under the One Big Beautiful Bill Act, signed in July 2025, the cap has been raised to $40,000 for tax year 2025. For 2026, it increases 1% to $40,400. This annual 1% increase continues through 2029, and then the cap is scheduled to drop back to $10,000 in 2030, unless Congress acts again. So at first glance, this looks like a huge win. And for some taxpayers, it genuinely is. But here is where freelancers need to pay closer attention. The first hurdle is that you must itemize to claim the SALT deduction. For 2026, the standard deduction is $16,100 for single filers and $32,200 for married filing jointly. If your total itemized deductions, including SALT, mortgage interest, and charitable contributions, do not exceed the standard deduction, the raised SALT cap does absolutely nothing for you, boys. You would take the standard deduction anyway. Many freelancers, especially those who rent rather than own a home, fall into this category. Without a mortgage interest deduction and without property taxes, your SALT deduction might only consist of state income taxes. If you are a single freelancer earning $80,000 a year and paying $5,000 in state income tax with no property tax, your SALT deduction alone does not push you past the $16,100 standard deduction threshold. The raised cap is irrelevant. The second hurdle is the income phase-out. The $40,400 cap in 2026 only applies in full if your modified adjusted gross income is $505,000 or less. Above that threshold, the cap is reduced by 30 cents for every dollar over the limit. It floors out at $10,000, which means once your income reaches roughly $601,000, you are back to the old $10,000 cap. High-earning freelancers who would benefit the most from a larger SALT deduction are precisely the ones most likely to be phased out. Now, here is the group that does benefit clearly. If you are a freelancer who owns a home in a high-tax state, itemizes deductions, and has a modified AGI under $505,000, the raised SALT cap is real money. Suppose you pay $12,000 in state income taxes on your freelance earnings and another $10,000 in property taxes. Under the old cap, you could deduct $10,000 total. Under the new cap, you deduct all $22,000. At a 24% tax bracket, that is an additional $2,880 in federal tax savings. But here is the strategy that most freelancers are missing entirely, and it is arguably more powerful than the SALT cap increase itself. If you operate your freelance business through an S corporation or a partnership, you may be able to use a pass-through entity tax election. Over 36 states now offer this. Here is how it works. Instead of you paying state income tax as an individual, your business entity pays the state tax at the entity level. That entity-level tax payment is a business expense, fully deductible on your federal return with no cap at all. It completely bypasses the SALT limitation. Let me show you the math. Suppose you are an S-Corp freelancer in California, earning $200,000 in net business income. California's top marginal rate would put your state tax around $18,000. Under the individual SALT cap, you can deduct up to $40,400, so the full $18,000 is covered. But what if your income grows to $300,000? $400,000? As your state taxes climb, the PTET election ensures every dollar remains deductible at the entity level, regardless of the SALT cap. And here is the part that makes this even more valuable for freelancers specifically. When state taxes are paid at the entity level through PTET, they reduce the net income that flows through to you on your K-1. Lower pass-through income means lower self-employment income, which means lower self-employment tax. The SALT deduction on your individual return does not do that. It only reduces your income tax, not your self-employment tax. So what should you actually do with this information? Step 1. Calculate whether you should itemize or take the standard deduction for 2026. Add up your state income taxes, property taxes, mortgage interest, and charitable contributions. If the total exceeds $16,100 for single or $32,200 for married filing jointly, itemize and use the full SALT cap. Step 2. Check your modified adjusted gross income against the $505,000 phase-out threshold. If you are above it, your SALT cap starts shrinking. Step 3. If you operate as a sole proprietor and your freelance income is consistently above $75,000 to $100,000, talk to a CPA about whether an S-Corp election combined with a pass-through entity tax election makes sense. In high-tax states, this combination can save you thousands more than the SALT cap increase alone. Step 4. Remember that this raised cap expires after 2029. Do not build your entire tax strategy around a temporary provision. The PTET workaround, business expense deductions on Schedule C, and retirement contributions are permanent tools that will outlast any congressional cap. The raised SALT cap is a genuine improvement for freelancers who itemize and live in high-tax states. But for most freelancers, the real savings come from strategies that go beyond the SALT deduction entirely. Subscribe for more actionable tax strategies built for the self-employed. See you in the next one. This content is for educational purposes only and does not constitute tax advice. Consult a qualified tax professional for guidance specific to your situation.